Hello, and welcome back to another episode of the Investor Financing Podcast. We're going to talk all about self-storage, buying self-storage from the ground up and building them. We're going to talk about conversions. We're going to be talking about identifying opportunities for maybe somebody who's just starting out. We're going to talk about scaling and growing a big operation. Please welcome AJ Osborne to the show. He's an entrepreneur, businessman, investor. He owns and manages his self-storage portfolio, well over $200 million of assets. His companies are Cedar Creek Wealth, Bitterroot Holdings, and Clearwater Benefits. So this is going to be a great show, guys. Whether you're just getting started or you have owned some self-storage properties, we're going to kind of touch on everything and learn a lot today. AJ's company also does feasibility studies for other investors that are up and coming, where he does full reports where you know if there's demand there, if you should maybe pass on the project because it's not a good investment. It's well worth it on anything, especially I do a lot of financing, and SBA 7A and 504 are both lending tools for self-storage, and they usually always want a feasibility study in the package. So I know I was talking to AJ before we went live, and now, I know SBA financing. I don't own any self-storage, but I'm thinking, wow, this is a great tool where I can buy an existing facility and get 90% leverage. If you're building ground up, you're maybe 80 or 85% leverage. You're getting very high leverage. So learning this business and tooling with SBA in the beginning, I think, is a great start. And then as you're going to hear AJ's story, he's progressed where he's doing syndications, and he's got investors that love to invest as an LP in these transactions because they're getting great returns, and they're investing in a recession-proof type of industry over the years. So we'll dive into the inflation, what that might look like for self-storage operators, if there's any concern there. So welcome to the show, AJ. Thanks for joining us.
Thanks for having me on. That was best intro I've ever had. Thanks, man.
I always try to study up a little bit, and I don't want to go back and ask your history. I know you were a corporate guy as a benefits manager. You got really sick at one point after your fourth child, and I think you just said there's got to be a better way, and that's when you really dove into self-storage years and years ago, and then you just have grown ever since. But can you kind of talk us through your first self-storage facility and the process that you went through to figure out how to acquire it and how to finance it and how to bring in investors, and what that looked like to today, where you're doing these huge projects where you're acquiring stuff for $12-20 million. You're bringing it, you're doing $10 million of improvements to the property, and now you're even getting to the point where you're splitting lots, you're developing multifamily alongside the self-storage. So you really come full circle. You've built in automations. It's going to be interesting to hear, but I want to first talk about the first project and what you learned on that, and then what really got you excited to say, oh my God, I'm going to replicate this and grow.
Yeah, 100%. We, it was funny. When I first was looking at real estate, I was actually looking at small multifamily, things like that. My father bought a storage facility in this small little town, and he was like, we need to do this. And he bought it with another partner, and he was like, hey, let's go buy these, right? And to be totally honest, at the time, I didn't really know what storage was. This was in the early 2000s. Storage wasn't a mainstream asset. Most people hadn't ever used a storage facility before. Investors didn't know about it. There was nothing on it. There wasn't education book, nothing. Banks didn't even like it. But when we looked at the P&L, the cash flow was really, really good. And I hadn't been able to buy any other real estate because the cash flow was so bad on all of them. And to be honest, I didn't really understand real estate. I was in business. I sold benefits. I worked with companies to do their management of all their healthcare dollars, including self-funded. And I was a sales guy. And so self-storage had cash flow that we viewed could offset our fluctuating sales income, right? So with our sales, our income would vary greatly. If you lost a client, I could lose 35, 40% of my income. So it was like, we need stabilized cash flow outside. We need high margins, right? We need that kind of stuff. And storage fit the bill. But we didn't really know what we were doing or how to do it. So we went to very, very small cities where we could buy little facilities that were just gravel drive up. There wasn't really anything to them. And we bought them, and we would try to basically maintain and increase cash flows. But the philosophy was that I had is, this isn't real estate. This is a business. And that's why I liked it, because I thought, okay, this isn't actually a real estate asset. This is a functioning business. That means our skills and my skills that I had with business, we could apply to real estate to get higher yield. So that's what we started doing. And we would invest in these small ones, we'd turn them around, I'd refinance them, we'd reinvest, and we grew our portfolio that way. Our money, though, we spent most of it on the business of real estate, not real estate itself. So we were buying technology, we were focusing on operations, we were building out franchise systems to be consistent and scalable, that would create a repeatable process that we could identify and really maximize yield on these assets. And so, we worked on that for years, and that was our focus. We didn't take money out of it. We just re-poured the money back in, and we kept building. And I was working for a big company called, well, maybe I shouldn't say the name, but a big corporate company, doing benefits for them, running their branch and everything here. I became paralyzed out of the blue. I became almost overnight a quadriplegic. I was hooked to tubes on life support, where I was on life support for over 2 months. And then after can't even remember now, 3, maybe 4 months, I went home in a wheelchair, paralyzed, lost my job in the hospital. Obviously, we didn't even know if I would ever leave the hospital. We didn't know if I would ever leave tubes. And so then from there, it was all storage after that. It was like, I'm not doing anything else. My job is too risky, and I need to focus, because when I got out of the hospital and as I was lying home in bed paralyzed, I was like, my assets are worth more and they're generating more money than when I went into the hospital. At the same time, I lost my job. So from there, it was like, this is important. This is impactful. And we really understand this. So after I got out, we focused, we refocused up on that, and I started to build more companies around it, as well as decided that we are going to allow other people to come in and participate in financial independence, freedom, because it meant so much to us and it saved my family's financial life. So from there, we allowed investors to come in. And as investors started to come in, that expanded our scope of how many properties we could buy and what we could do. So we kept going, and I do everything. So I own property management systems in the industry, technology platforms, founding members of the largest co-op in the space. We've done conversions. We were one of the first people to really implement hardware and software system to create full automation that didn't exist prior to that, because you didn't have a full automated. It was just a hogposh, and most of them are just a hogposh of technologies, but it's not really automated. So we were pioneering that. We're pioneering software now that can do that at maximum. So we bought office buildings, bankruptcy for Kmart's, turned them into storage facilities. We've done ground up. The last, we just bought a portfolio for over $75 million. So far this year. So we're really, really engaged in this asset class. We understand it extraordinarily well. We're proficient at it. And our whole business has evolved around it.
That's amazing. So when you got better from, basically not being able to move, it almost sounds like, you just said to yourself, like, all right, we're going to do this. And it almost gave you like a supercharged, I mean, something in your mind said, listen, this could happen again. Like, I don't know. Like, and I think at that point, it sounded like you didn't have any fear anymore of like failing, right? Like you just said, I can just do this, right? Because you all of a sudden just over, I don't know, well, it's been like 10 years, 12 years now?
5 since that happened.
5 years.
Yeah.
So
I'm still partially paralyzed in my lower legs, so I can't run. I have pain 24/7, but I'm up and walking, so I don't like that's more than we could imagine. When I was in rehab, a few years ago, they're just like, you're never gonna not be able to use your arm braces. You're never gonna get out of your leg braces. They're like, you've been doing this, AJ, for 3 years. You kind of just gotta accept it. And for a long time, we thought I'm never gonna be able to walk on my own, and then I stopped going. Once they told me that, I stopped going to rehab because it was like, there's no reason to be here if you guys don't even think I can accomplish my goals. And I just went home, and my family, my kids, became my rehab, and I'd carry them around. And we decided this, this isn't going to define us. So it was like, nope, I'm walking. I'm going to do this on my own, and we just got to do whatever it takes. And we just moved on. It was like life will go on as normal as far as health-wise go, even though it wasn't. We're not going to let this be an excuse. And you're right, something tripped in my head, and it was like, we've got to, like, I got a second chance, and I couldn't waste time anymore, and I couldn't, after losing so much, I was so grateful for what I had, but at that same token, time became precious. And after what I went through, fear was not irrelevant, but it wasn't the same. I didn't perceive the world the same anymore. And that put rocket fuel under us. I started 3 companies out of a wheelchair. My wife built a school after that for entrepreneurship and business, which she has a campus. She has hundreds of students. It's K through all the way through high school. And we went on overdrive, and it was like, we don't have enough time. We're not going, if we don't like something, we're not going to sit around and wait for somebody else to fix it. And there's no excuse for us not to be going, to be moving. And things changed rapidly and massively. The sense of urgency, I think, that overcame me was almost a little overwhelming. It ought to be honest. It was like, I've got to move, and this time is so precious. And maybe it was just that I feel like there was nothing I couldn't do. And so after being through that, it was like, what's the worst that could happen? And it's like, I mean, there's so much physically I couldn't do, and so much I lost, that I think maybe I was trying to compensate on the other side too, but all in good ways. I think the fear that I had was taken and was replaced from, I think, what a lot of people feel. And that fear was reallocated to me in the fact that I would become the guy in the wheelchair. And that had nothing to do with if I was actually in the wheelchair. I was fine with that. Like, I didn't care if I couldn't walk on my own. It was that I identified as that was who I was, right? It's one thing to be in a wheelchair. It's another thing to say, that's who I am. And that I could not live with. And so it was like, even if I'm in a wheelchair, this won't define me. This won't be me. This won't be who I am. And so we went on overdrive.
You just gave me like chills, man. Like, that was really deep. And like, I was just thinking about like being in your situation, like, and that's a lot to take in, because you spent your life, and all of a sudden you couldn't move. But anyway, I'm glad you're recovered, and I'm glad that obviously I could just, before we went live, you're so passionate about what you do. And I knew you'd be an awesome guest to have on the show because, you really dove in and figured this business out and innovated this business in many ways. So it's great to have you here. If somebody's listening or watching this show, and they might own some real estate, some single family, some duplexes, some small multifamily, and they're looking at maybe acquiring their first multifamily. Well, one is first, where's the best place to get education? I know you have 2 mastermind groups. Do you guys kind of go through that in your mastermind training, or is there a better route where somebody could say, okay, let me learn the fundamentals. Here's the spreadsheet you need to underwrite with. This is what you're looking for on your first deal. You want to make sure you got at least 100 units. Where do we start?
Yeah. So first of all, every single piece of information that we have and put out is for free. There's nothing that we hold back. You can go onto YouTube. You can go onto my podcast. You can go onto my Instagram. We walk through deals. We walk through underwriting. We show it all. My idea and what I wanted to accomplish in the hospital was we would teach others how to do it, or we would do it for them. And so we do have like our group things that it's more in depth. My view was, if you want my time, that changes the parameters. But other than that, everything's for free. You can go out, find it. Really starting it is you need to binge this stuff. So if you're looking at getting into storage is not like other asset classes. It's unique and it's its own world. And you need to binge. I literally go onto the podcast and just start listening to all the podcasts so you can understand the industry, understand the asset, understand how you value it, how you think about it, what markets are doing, what are the drivers of revenue growth, and what are the eroders of revenue growth and value. And so you can start to really get a better idea of the opportunities, the dangers, where you might want to take advantage. As you're going through that, you can get a lot more in depth, right? You can go start looking at videos of case studies, underwriting that we did, why we like those deals, why we don't. There's so much there, and there's so much opportunity. Now, for people that are like, hey, I want a lot more, I want it a lot more consolidated, things like that. Yes, we have the masterminds and the groups that are like, I'm ready to go, I'm ready to take advantage of. But honestly, if you're starting out, you can just go consume all the information. I have the #1 best-selling book in our industry, and I wrote that once again after I got out of the hospital. It was like, all right, let's tell everybody about this asset class. There was no good information about it, so I wrote the book, The Investor's Guide to Growing Wealth and Self-Storage. You can go pick it up, and that's a complete walkthrough for beginners. Here's how to do it. Here's case studies. Here's how we look at it. Here's what to do, why, a complete A to Z all the way through, management and everything else. And I think that, when you're looking at getting started, you have more of the macro views, like the waves and opportunities and things. And most people get on that overall. They have an understanding of the value. They see that wave, or they understand it better. And then they need to understand better the micro strategies of executing on that wave. Now I got to learn to surf, right? So I can actually ride that wave. So it's really understanding this wave of self-storage. Who's playing in the game? Who's understanding it? And then from there, okay, I get it. I like it. How do I take advantage? Get a lot more in depth then with our research or our all of our content. And you can really dive in and start to see the picture evolves, right? And you can really start to understand and see opportunity.
That's amazing. So we're obviously in an extreme inflation environment. Historically, in like a recessionary period, how does self-storage fare versus other asset classes?
So I'm going to kind of preface this. First of all, I'm, being the largest voice in our industry, as far as podcast and everything else goes, I'm not a hype man. So I am very, I think, different. I don't make money from doing teaching, anything else like that. I do real estate, right? So by being outspoken, being on podcasts like this, I get deals, people bring me assets, and I get investors. So for me, I'm not a hype man. I don't want to be a hype man. That's not the point. That's not the strategy. It's not anything that we're trying to achieve. So when I'm looking at the overall risks analysis, I'm actually extremely open. And I wrote a long Twitter thread that had it was something crazy, like 700,000 people read and viewed it, because I walked through all the risks in self-storage. And at first, I thought nobody was talking about it because I thought it was just more, everybody was kind of hyping it up, everything else like that. I quickly learned it's because nobody understood it. And this is one of the problems that you have in self-storage. Self-storage is the newest real estate asset out there. Prior to 2008, it had never gone through a debt cycle. So what happened after 2008 is everybody looked at it and said, this asset did so well. So here's all the lines that you're going to receive, that I'm going to give you context to them so you understand. The goal is not to own self-storage. The goal is to create wealth and income. I think self-storage is the best commercial asset to do that in, but we need to understand it. So during 2008, it was the lowest defaulting commercial real estate asset out there. It was also the highest occupancy. And people look at that and they say, this is the safest asset out there. I get that, but that is so surface level and you're missing a large part of it. And I think that really actually fools people to the reality of what's going on. And here's why. Prior to 2008, you couldn't get lending on self-storage. So self-storage had the lowest debt to income and debt to equity of any commercial real estate out there. In fact, a huge majority of them were debt free. You're talking about lower than 50% LTV. At the time, most real estate assets had well over 90, most of them over 100. So they're not even comparable. The reason it didn't default is because they had no debt. And we had high occupancy because our occupancy and rates are very easily manipulated. Meaning, I was buying assets because I actually went through the recession. We bought assets. I owned assets through it. But you had assets that the revenue dropped by 50%, even though occupancy was 85. So I try to tell people, and this is why I became, in the self-storage industry, I think kind of how I became known and why I became known is I said two things. Occupancy doesn't matter, and self-storage is a business. And I was trying to help people out there. But I bought a lot of facilities that went bankrupt, went out of business. Today, that is not true. So today, institutional plays in it. Prior to 2008, institutional money didn't play in self-storage. It didn't invest in it. It didn't lend to it. It didn't invest in it because it couldn't model out performance because it had never been through a long-term debt cycle. But it also had no way to manage the asset. There was no third-party management. So nobody played in it except mom and pops. 90% of everyone that owned storage facilities when I got into the business owned one and were mom and pops. That's how fragmented this industry was when I got started. After 2008, institutional third-party management came out and banks could now lend to it. Institutions rolled in. We started consolidating the industry. Now the debt to equity in self-storage is nothing like it was prior to 2008 at all. It's not even almost the same asset class anymore. It's totally different. So I have to always preface it by saying it did really, really well. But we need to understand why it did well. You should not expect the same thing if you're buying it and you have 80, 90% debt on a self-storage facility and you go down to 85% occupancy, but you cut rates by 40%, you won't pay your bills. You're going to default, right? You do not have that cushion and that buffer to survive. And so we need to make sure that when you're getting into self-storage, you understand what can create those circumstances. And really what it is it is a demand component. Self-storage is astronomically sensitive to demand. So demand can be really overbuilt locally. So this is a 3-mile game, right? So you have within your radius, I can find pockets that have super, super high demand. No new storage facilities are being built, everything like that. I can get into them with confidence. I'm going to operate them, and it's going to have a really, really low default rate. Right? Now, I can go to other areas that were growing and they were building storage facilities everywhere. Even though that's a growing hot market with high rates, you may have a lot of risk of defaulting because when things slow down, all that excess space now is on the market. So what happens is you have a downward cycle of rates, cutting things and everything else, right? So in order to be successful in self-storage, you have to know what makes them default, what makes them have value, and what makes them safe. And right now, we're at a point in the cycle. So prior to 2008, we had never had a year that had I think it was even $1 billion spent on construction. Since 2016, every year has not only doubled it, but we've gone to 5x the highest year ever, every single year in development. So we are at the end of a huge development cycle in storage. That's why we're sitting here talking about it, right? Because everybody knows about self-storage. Everybody wants to be in it. Now, people are like, oh, so the opportunity is over. Not at all. So when we say that, what I try to do is not create extremes in one end or the other. It's not doom and gloom at all. There's still, I believe, more opportunity than any other asset class. But it is not build it and they will come. If you build it or buy it and think that it'll work out, you could get yourself into serious trouble, like any normal asset class, right? So when you look at it, what we need to do and understand is that self-storage, still 50% of this asset class is mom and pop owned. When I'm looking at storage, I'm trying to buy underperforming facilities that I could maybe have upside, that I could do a good job at. Well, if I go into apartments, over 80% of apartments are institutionalized. There's way less ability for me to find assets and buy them because I'm going to compete with all the big boys. Self-storage, there's a massive market for individuals to go find storage, to buy them, to start small and to grow big that doesn't exist in most commercial real estate assets. It is still, hands down, I think, the best opportunity of any commercial asset. Now, with that said, it is not nearly as safe and it is not quite what people think it is. And so you need to go into it with the correct expectations, understanding what it takes. People think that it's passive because there's no toilets, right? Well, we view this as actually a retail business. We have short-term contracts. We invest heavily into marketing and technology, customer acquisitions. We have turnover every single month. People are moving in and out. We finance our own insurance for tenant insurance. We sell products, services, and we compete with other businesses. So we compete with other storage facilities to try to get customers, right? So it's an active operating business. It's passive on one side, but then it's extraordinarily active on the other. So apartments are passive on operations, but they're super heavy on things like CapEx and tenant management, right? And that kind of stuff. Like storage, tenant management's nothing. I don't hear from them. It doesn't matter. But now operating, filling up units, operating the business, getting people in, out, moving, trying to get the revenues up. We do things like dynamic pricing. We're changing rates all the time. That stuff is very active, which it's not really active on like multifamily. So you have to understand the opportunities that lie in self-storage, what makes it a great asset. Once you get that, the yield and the upside you can achieve from this asset class is so much higher than most assets that we can find. In fact, I'm fairly shocked at the returns that most people are willing to accept in commercial real estate because I'm like, why would you even buy it? It's like those returns are so low because in storage, we can get such high yield.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. And when you're developing from the ground up, there's third parties. I mean, it's a pretty quick process. I mean, once your plans are approved and so forth, are you buying like just prefabricated shells essentially, and you pour the pads, lay the gravel driveway or pave the driveway?
100%. Storage development's very easy. This is a good thing and a bad thing. So it's a good thing as far as if you're building like I do, because it's fairly simple. You have the ground, we have pads, we do. Now, some ours isn't. We'll do multi-story, 4 up, 1 down. We have we'll do business systems within it. So it can be extraordinarily complex. But at its basic level, it's pads. You hire the metal manufacturers. They come in and they install the units. Maybe you have an office, maybe you don't. You have a gate and security cameras, right? Very simple model. Now, that's good when you're developing. The bad side about that is that's why self-storage is so prone to being overbuilt. It's easy, and 2, it's cheap. So you have people that don't have enough money to do other major real estate asset classes. So instead, they build storage. Why? Not because there's demand, not because it even makes good business decisions, but because that's what they can afford. And that's not good for markets, right? Like the nice thing about multifamily is very safe and secure. Because if I'm going to go build a multifamily that has 600 units, I am going to spend astronomical amounts of money. You can build 800 units in storage for $6 million. Like that's unfathomable in other commercial real estate asset classes, right? So then all of a sudden you have lots of people going and building hundreds and hundreds and hundreds of units. So that's the good thing about it is it's easy to take advantage of opportunities that are there if you can find it. The bad thing about it is that everybody can. So when you look at it, we're looking for areas that actually don't like storage. The good thing is lots of municipalities don't like storage. And the reason they don't like storage is the impact of tax revenue is so low for the utilization. They get like no taxes on it compared to if you had 10 acres, you had multifamily, you had a business, you had strip malls, you had something like that. That's high tax revenue usage. Storage is not. It's really, really low usage. So a lot of municipalities are they're now starting to understand storage and they're trying to regulate it better. We had the problem over the last 10 years that you had cities that didn't get it. They just approved all over the place. We're starting to get a better hold of it. What's happening in storage is storage was an adolescent. It's now maturing into a mainstream asset class, but it hasn't matured yet. So there's still a lot of confusion around the asset class. And there's a lot of growing pains with it. Now, the storage has benefited from the best 5 years ever in history. COVID was like the greatest blessing to storage that has ever been around. I mean, I don't know how much of the money they printed went to storage operators, but it was a tremendous amount, right? I mean, we had 96% occupancies. We were raising rates at above double digits every single year. I call this the COVID bump. That's nowhere near normal. Normally, we are looking at the next highest year prior was 86% occupancy. And you didn't raise rates double digits, right? So now we're going to see an inflection point and people need to be careful because we're coming off COVID. That's the same with every single asset class, right? COVID helped a lot of these asset classes, like some of them it killed. So absolutely just killed hotels, right? Retail centers. But some of the asset classes, it made them boom, industrial self-storage being them. We're cooling off now. We're coming back to more of a mainstream place. And you need to realize that when you're looking at buying a storage facility, the last 3 years of income you should not expect for the going three because COVID's coming down. It won't be the same. But the COVID really, really helped storage. It made our industry boom. Now, rising interest rates are going to change that. So 45% of all our customers come from moving. The housing market's stagnating. 99% of all mortgages in the United States are less than the interest rates today. 99%. And over 80% are half of today's interest rates. So people are not being able to move. They're going to stagnate. That is going to affect our asset class because 45% of our customers come from people moving. We trail the housing market by 1 year. This is a great year. We expect it to be a great year. We're raising rates because we know the softening is coming. We're already feeling it. We're already seeing rates. We're already seeing prices go down in areas like Texas. We're now feeling the effects of higher interest rates. And we're a seasonal business. So spring, summer are a busy season. Winter's the down season. When we go into winter, we're going to see a lot less occupancy. And then next spring and summer, we're not going to fill up like we did. So we are expecting those fluctuations. And when we go to buy, we're anticipating it. I'm not buying expecting the next 3 years. I actually am buying underwriting at they're saying, oh yeah, we're at 95 and we have been for 3 years. I'm underwriting at 88%, right? And they're like, yeah, you can get, we've been increasing 10% every year. We're underwriting at 3% increase. So we're adjusting our expectations. And this is going to be a really good thing because I think the heat on self-storage will start to back off, which we need because we don't want markets to be overbuilt. So that means if you're going to buy, you want it to be a healthy market going forward. So I think the interest rates are going to help demand because it's going to stop a lot of frivolous building projects. So on one side, interest rates are going to probably hurt us a little. It's going to slow down that customer acquisition process because the housing's stagnating. But on the other side, higher interest rates is shutting down developments, which means that we can have a prolonged period of much higher demand in the future. So we're looking at it saying the next 3 years are going to not be so great with storage, but they're not going to be so great with every single asset class. You would be ridiculous to buy anything today and expect the next 3 years to be like the last one, right? It's not happening. But after that, we actually think that this is a boom for self-storage because it's shutting down development. That means we're going to have demand that'll just be increasing. And then after the stagnation ends, there's going to be pent-up demand, which we should really, really benefit from.
Wow, that was really good. I learned a lot over this last couple of minutes of you. I had a question here. So when you're doing due diligence, whether it's a conversion project, a ground up project, or you're buying something that's mismanaged, general due diligence. I mean, like, let's just break it down for somebody who's more of a beginner. Yeah. What's the traffic count? How many other 100%. Facility? How many other facilities?
Don't worry about anything except two things: demand and execution. Meaning, you want to look for and make sure there's super high demand. So how you determine demand. This is a very hard thing to pinpoint in storage. We look at square footage. What you want to look at is utilization. So now you say, oh, well, everything's full. Okay, that's true, but everything's been full for a while and a lot of it artificially. So how do you really determine? See if new storage facilities have come on the market, okay? If you haven't had new storage facilities on the market for years and everything has remained full for years and you're getting rising rates and you have population growth, you're probably having high demand no matter what the square footage is because no new inventories come on, yet the population has grown. So demand's increased, but they've never been able to meet it. That's what I'm looking for. Now, if you have a market that was growing and lots of new demand came on and they're like, oh yeah, they filled up or they're filling up, my question would be, okay, but when that growth rate slows down, so you have a city in Texas that has 500,000 new square feet of storage that has come on board and it's now starting to fill up and they're going from a growth rate of 3% to 1.5%. Are we going to have demand? I don't know. So I'm not going to go there, right? So look for demand. Also look at that demand in future context. Go to the city and ask the city, what storage facilities are currently in development or going to come online? And if they say, we have nothing, that's good. That's a really good thing. The second side is demand first, always first, because you can't do anything about that. That's what I try to tell people. Demand is out of your control and it's a force that you can't fight. So number one thing, don't screw with it. If it's in question, walk away. It's just not worth it, right? Now, the operations is where we really love and key on because we can find mom and pop facilities. They don't even have websites. They're doing things off a napkin, right? You have 10% or 12% of the units aren't even paying. And it's like, well, you can go buy that and you can have a 12% increase in gross revenue day one just by making sure people pay. And then most of the time, those people are under market rates. They're not charging what they should be. So you can rebalance that. You can clean it up. You can get rid of delinquents. You can go in and actually create a website, start marketing, and charge normal market rates, and you can really lift that gross revenue. So when you're looking at operating, look at fundamentals. Are they not doing the basics? Are they not charging? Is their lease agreements not good? Or do they even have one? How is it being operated? Are they not marketing? Or are they marketing, right? You don't need to be a genius to figure it out, a business whiz. You just got to collect bills and make sure people know that you exist. And there's so many of those mom and pops that aren't doing even that. And you can buy those and have an incredible business that was simply just being mismanaged. High demand, bad operations means high yield and great returns.
Amazing. This has been I could pick your brain for hours, but I know you're very busy, so I'm not going to do that. Guys, go to selfstorageincome.com. Go to iTunes or Apple Podcast, AJ Osborne Podcast. You can go and if we do get some, and then obviously read the book. I'm going to put the link below. Binge the podcast, read the book. Then you'll have a great understanding to hit the ground running. And then after we're got our first deal and we're analyzing it, you do have another division that will actually do a feasibility.
Yeah.
And I think there's different stages of the feasibility.
Yeah.
So you can get a third-party independent company to look at the deal. They're going to look at all the key drivers. Do you actually? Can you kind of walk through that part? Just 'cause I think that's so
This is a
valuable
really
for somebody.
important thing. You're
Yeah.
exactly right. So I still will get feasibility studies from third parties, even though we do it. And I did that even after I owned over 50 plus million of storage. I still got feasibility studies. First of all, number one reason is banks are usually going to require it. But the second reason is I always wanted somebody else that knew things I didn't know to tell me. And principally on that first point that I made, is there demand? And so the feasibility study, we look at twofold. We look at, first of all, the overall market, and we're looking at the demand in the market. Is the demand there? Is this going to be a good market for a long time, right? We look at the competitors. We look at all that kind of stuff. We look at new assets filling up. We look at rates. Then we do a comparison of the asset in the market. Is it on the top of the market? So like risk, if you're at the top rates, you're the best operating facility in that market, there's new facilities coming on board, and the market's not growing, your risk is huge because you only have down to go. And there's new supply coming on, and that there's no one there to fill it up. That's what you're trying to avoid. So we're looking at that. Is it lower in the market? Can it be turned around? We want to see all about the market and all of that understanding. So when you do a feasibility study, we're looking at everything from financials. We're looking at a whole broad spectrum, and we're putting it all together so you can give to the banks, everything else. It's something we have our whole teams of underwriters and everybody else here that does for us. So that exact same thing that we do for others, we do on every one of our properties to produce it.
That's amazing. Thank you so much. This is so cool. I mean, this was really eye-opening for me because, like, the way you break it down. I mean, I was just like, oh my man, like I could, you explain it in a way that I understand too. So like, I'm not an expert by any means in self-storage. I financed a few in my career, but that doesn't give me like I'm like, okay, well, what are my steps? And now I think I have a good path of like my knowledge curve, right? And all the information is pretty much free that you put out for us to like learn. Hey, listen to the podcast, read the book. It's pretty simple if you want to kind of get that game, because I feel like the opportunity for somebody starting out is obviously we're not going to go out and buy a huge facility. We may be a passive investor if we have a lot of capital as a limited partner, but really, if we're going to start out, we're going to start out where we're not competing against guys like AJ, because we're not going to compete with guys like AJ. But there's enough in the mom and pop world for people like me to get started, and that's what's amazing
100%.
about the businesses.
Yep. And that's even in the book and everything we go through starting out, because that's where we started. I mean, we started in cities that had like less than 3,000 people out in the middle of nowhere. So we started out really small, right, and worked up, and that's what we walk through, and that's what I tell people and teach and say, go where it's like, just go where you're gonna win. Like, so I have what I call my margin of stupidity. And Warren Buffett has his margin of safety. Mine's my margin of stupidity because I'm not Warren Buffett. So I say, even if I'm stupid, we'll still be successful. That's what I look at in feasibility studies. That's what I look for markets. Meaning, if this strategy is dependent on me being super intelligent, we shouldn't be doing it, right? Because it should be just the market should be so good, the asset should be so good, we'll be fine. And then if the smarter we are, the better we can execute on it, that is just upside for us. But we shouldn't ever be depending on things to go perfectly or anything else. And that's what I suggest everybody does. Just go put yourself in the position to where you will be successful, even if you're making mistakes, even if you don't know what you're doing.
Love it, love it, love it. Everyone, I hope you got a lot of value out of this. This was one of my favorite episodes we've done in a while, because it energized me, and it's a great story. And it just goes to show you, if you learn this business or learn any investing business, the sky's the limit, and it's just really understanding what you're doing. And you can see how AJ's like poured himself into this business. He knows a lot about it. He studied the economic cycles, and this was just a great episode. So thanks again, AJ, and thanks everybody for watching.
Appreciate it, man.